Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing and also give you a few key takeaways as you navigate the markets yourself. So, today we're going to talk about the three topics. Number one and two are the big ones in the news: inflation and interest rates, both going up. Inflation in February, 1.7%. Interest rates, 10-year treasury up above 1.6%. Well, I don't think it's time to panic just yet. And let's end on a positive note. US consumers in a very good financial position, saving at an extremely high rate relative to history. So, first off, inflation. February consumer price index, most common inflation rate tracked, 1.7% year over year growth rate for the month of February. Important to note that met expectations. So, nothing alarming about that on the surface. Most of that growth was due to the rise in energy cost and gasoline and things like that. What many people are worried about is if inflation continues to grow and grow. And then, of course, the Fed may have to increase rates. That typically has a negative impact on the stock market. I think it's a little too early for that concern. If we take a look at the next chart here, this takes a look at inflation broken up into buckets. So we see the point where we're at right now is that 0 to 2%. The first one, second one from the left there, we're at that 1.7, right in that bucket. We can see the average valuation across all buckets, that's the highest. So what's that mean? That means when inflation's low, typically stock market valuations are at their highest, which is exactly where we're at right now. Now, for me, the takeaway is this: until we see inflation persistently above that 2, or even really above that 3 or 4%, historically, it hasn't weighed on equity market valuations. Now, interest rates are somewhat linked, but also interesting here. We see the Treasury up dramatically. We've seen this have a little bit of short-term implications on growth and technology, with the NASDAQ recently having a 10% pullback in just 15 days. And that spooked a lot of investors. I think it's important to take a step back here. At 1.6%, we are still nearly a half a percentage point below the level we were at entering 2020, before, of course, the pandemic recession that we experienced. So extreme short-term momentum, bigger picture, not a very high level. Number two, let's take a look at stock market valuations when interest rates are this low. This chart looks on the X horizontal axis at the interest rate. So the further right you go, the higher the interest rate. The further left you go, the lower the interest rate. Of course, the US Treasury rate 10-year is what we're talking about. And then on the vertical axis is the price to earnings ratio of the S&P 500. All right, so what we see is a pretty clear relationship. As interest rates are lower, valuations are higher. As interest rates get higher, valuations get lower. Okay. Now, I wouldn't argue that against the notion that valuations are a bit stretched, especially on a trailing basis relative to history. But I think it's important to look at this and say, okay, valuations are high, but given the low interest rate environment, this is not completely out of the norm. Now, if we continue to see interest rates rise over the next few years, 3 or 4 or 5%, okay, that is when I think it's going to put pressure on valuations. I don't think it's necessary to panic just yet. On a good note, US personal savings rate at 20.5%. Some of this on the heels of the direct payments in January that people received from the stimulus bill that was passed last year. And of course, people are about to get more money in the next quarter or so from the new stimulus bill. People are saving the money. We see credit card balances declining. People are paying off debt and being very conservative. Why is this so important? Retail sales, consumer spending, corporate profits. This is a lot of pent-up demand from investors, especially when we consider that the long-term average is only 8.4%. If we see a return to normalcy, that is a lot of money that could flow back into the economy. And finally, our fun story this week: NASCAR. I'm not personally a big fan, but it's a very popular sport, instituting the COVID-19 detecting dog. This one flew under the surface for me actually back in January. From what I've been reading, NBA utilized these, and apparently they're very effective. Just for everyone out there, if you're planning on spending any time at sporting events, when live events come back in the next 12 months or so, I think you might be seeing some dogs here. So be on the lookout for that. So with that, I want to thank everyone for watching, and I will see you next time.